welcome to this Market Perspectives update video. My name is Andrew Krei. I'm the Co-Chief Investment Officer here at Crescent Grove Advisors. On behalf of myself and my colleagues, thanks for taking a little bit of time to watch this video amidst pretty extraordinary market volatility, uncertainty, trade and tariff policy dominating the news these days, and markets reacting in a pretty negative fashion and swinging around wildly day to day. Generally, we record these videos as a sort of a companion piece to our quarterly perspectives that we put out. We wanted to record this that would, in a way that sort of bring you more up to speed as it relates to the events we've seen unfold post-quarter end in this case. So we're recording on April 11th. The numbers that you're seeing are going to be as of the most recent close. And again, just wanted to give you a more relevant update as opposed to what feels like ages ago now, the end of Q1. So with that, we'll jump into three really key themes that we're looking at right now. One being tariffs. Obviously, that's sort of the topic du jour at this point. Everybody focused on trade policy, what the administration is going to do now and going forward. Diversification. It's finally working again as it relates to U.S. versus non-U.S. assets in particular. And then the last piece that we'll touch on here, the other key theme is really just looking at, in a historical context, what does it mean when markets dislocate 10+%? What are your expectations then going forward in terms of forward-looking returns in a scenario like that? So we'll give you a little bit of perspective across each of those three themes. And without further ado, we'll jump in. So as it relates to tariffs, we're seeing just massive uncertainty around the rhetoric from the administration. We've seen the tariffs that have been announced now implying about a 23% weighted average tariff rate, which would put us back on par with what we saw kind of in the 1930s level of trade policy. Smoot-Hawley, Great Depression era. Subsequent to that, we saw WTO, NAFTA, all these sort of iterations of the sort of freeing of trade, if you will, around the world, bringing down tariff levels to very low levels. Now, again, reverting back to pretty significantly high levels in historical context. And that's caused massive uncertainty. And certainly the globalization that we've seen around the world and sort of the U.S. percentage of imports as a percentage of GDP is significantly higher today than where it was 30, 50, 70 years ago. So needless to say, that's causing all sorts of implications and derivative effects across markets. I think if we just take this and look specifically at growth and inflation expectations and then sort of tie that into Fed policy, what we see here, we plot a couple different scenarios. If there were no tariffs, if we kind of went back and reversed everything at this point, what would that look like? Well, based on sort of sell-side consensus and expectations, you'd expect a slowing in growth from where we came in last year, which was a pretty robust level of GDP growth. Not concerning, not recessionary, but slowing somewhat. But then when you start to apply, let's say, a 15% tariff level, which would suggest that the administration might roll back some of what they've announced already, you get down to call it like a 1% level of GDP growth. But if they really move forward the current levels that they're talking about, this 23% that's been announced on a weighted average basis, that's where you start to look at sort of a recessionary type of environment. Slightly negative growth is about the base case. And when you look at sell-side research, when you look at the Fed's models. And then I think on the top right part of this chart, really what's most important alongside the declining growth expectations is you see elevated inflation expectations. The more tariffs you put on these goods, the more you expect to see CPI levels, inflation levels tick up towards, call it 4% as a baseline case, if we do see these 23% type of tariff policies enacted. I think the big question there is, what can the Fed do in that environment, right? They can't cut rates significantly because they need to fight inflation, but they also need to support the economy. So we end up with this sort of stagflationary mix of economic data, which is really a difficult thing for the markets to digest because equities generally don't do well when growth is declining. Long-term bonds, which tend to be the offset to equities in a diversified portfolio, don't do well when inflation expectations are rising. So you've got this mix where you just don't have anything that really works well beyond sort of cash and short duration type of instruments. That's what the market's trying to digest right now and trying to understand, is the administration serious about this sort of 23% level of tariffs, or are they actually going to roll back? Is it an escalate to de-escalate kind of strategy? So the second theme we want to talk about is diversification. What we had seen the last couple of years really was that U.S. growth stocks were more or less the only game in town. And if you look, going back again over the last 18 to 24 months at the chasm of outperformance from the Magnificent Seven, as they've been dubbed, these mega cap tech names relative to everything else, was really the only game in town in terms of, you had to be in those names, otherwise you're going to meaningfully underperform the sort of broad index levels. Now, what we saw in Q1 was a real reversal of this trend in the sense that you actually benefited from being outside of the US, benefited from being in value stocks, benefited from being in bonds, let's say, even relative to, again, that sort of growth cohort of stocks within the US. As you can see on the chart on the left of the slide, you can see these growth stocks, Mag 7 names, being the worst performers over this period of time on a year-to-date basis relative to things like Europe and China, which hadn't done as well, certainly over the last couple of years, actually posting positive performance thus far. And I think the other piece to look at this, and say, the S&P 500 had done so well, did it even pay to have a global exposure in a portfolio? Did it even pay to keep your bonds because stocks have been compounding at such high levels? Well, if you look now and look at a global 60-40 portfolio, sort of the protection that that's given you, again, the fact that diversification has worked again, and the outperformance that you've gotten, especially in this sort of dislocated environment, a higher volatility environment, just suggesting that diversification is not dead after all. And I think if you look going forward, we ask ourselves the question, well then, it worked in Q1, it's worked so far in Q2, but then can it persist? And I think the big thing that we'll look at is valuations. So even in a period here where the US has done relatively less well versus non-US stocks, what you see is that US stocks are still trading at pretty elevated levels. So they derated somewhat off of their peaks, but they're still trading at historically high levels when you put them in sort of a 20-year context. Whereas the rest of the world, whether that's developed international stocks, things like segments like Europe, like Japan, or emerging market stocks are trading at much more reasonable levels, either closer to their longer term averages or in some cases a little bit cheaper relative to their averages. So we'd point to that as kind of this relative value rotation theme that we'd expect to continue to play out over the subsequent quarters, particularly if there's volatility in the markets. People will seek those cheaper assets relative to things with much higher valuations. So the last theme that we want to talk about is just giving you some perspective on market dislocations, market corrections. We show you that this is really a feature of markets over time. Historically, going back to the mid-'80s here in this case, the last 40 years or so, the median average market drawdown, at least for the S&P 500 over that period of time, is 10%. We've had a drawdown sort of in line with that type of level this year. It's not extraordinary from that perspective. You see these things every 1, 2, 3 years, just depending on sort of the market backdrop. And I think the important piece of this, though, is what do you expect after you see a 10% drawdown in markets? Is this time to actually panic and sell, or is this a period where you might want to lean in or at least hold and kind of ride out the wave of volatility here? And what you see is on a go-forward basis, once you've experienced that 10% correction, on average, let's just take the 12-month forward-looking numbers here. If you don't get a recession, stocks are up 12% on average after that 10% drawdown. Even if you do get a recession over the next 12 months, you're modestly positive in equities. So what you see is you've created this sort of margin of safety. You've had this wave of selling, obviously, in this environment. We've seen this in the past, where it sort of resets everything in the market. Generally speaking, you're going to be better served holding your positions within equities, if not adding to those positions, because we've reset sort of the dynamics of valuations and so forth. Investors have gotten a little bit more panicked, and sort of the volatility leads to a washout of weak hands, and you can sort of reset off of that level. So again, we just suggest that you keep this period of market volatility in context. Hopefully this helps from a historical perspective to try to again, sort of appreciate that going forward, it's a much better environment after you've already gone through one of these periods of dislocation. This concludes our quarterly perspectives update. If we can be a resource during this period of volatility, don't hesitate to reach out. Again, I'm Andrew Krei, and thanks for watching.